All right, guys, welcome back to the Market Delta Footprint Deep Dive. This session is going to be on rotations and thin spots. I'm Anthony Drager. We're going to follow the footprints to profits, just more consistency, how to qualify. One thing I want everybody to think of when they hear the word footprint is a tool to read order flow. And that's what we're going to focus on, rotations and thin spots in this session. As I move on, I like to start a lot of my webinars as to why markets do what they do. And I often tell this story and show an image of my family, my brothers and I, my father on the left, that's me on the right. Because he used to always tell us, if you know how, you'll have a job. But if you know why, you'll be the boss. It always resonated with us. And then when I think about trading and helping others learn to trade, the why is order flow and market relationships. Those are the two key concepts. We're going to focus in this deep dive program on the order flow aspect, using the footprint as a way to make sure it's the best tool to do that, to read order flow. All right, so let's move right into bird in the sky. I like to educate using stories and metaphors so you could remember, have a better chance at just remembering the concepts. If I were to teach someone who was a nephew or my son or someone who I was going to fund their account, the first thing I would show them is a chart, and the first way I would explain that I want their eyes to visualize that chart would be a bird in the sky. If it left a trail and you were following it, what would it look like? Where are the rotations? The bird right now is where the price is right now. The trail it would have left is where it came from. Very important metaphor, bird in the sky. If you were watching it, following it, and it left a trail, what would it look like? That's how I want your eyes to fixate on a market. Now, when we go into simple candlestick bars, like the ones I'm showing you right now, my eyes would fixate on these candlesticks if it was the first time I was looking at it as, hey, the market's down here, it rallies to up there, maybe it comes down, retraces to down in here, rallies, comes down, and now it's up here. That's the visual I would automatically fixate my eyes, and how I would follow the market. I want you guys to remember something. If you can't follow a market, how are you going to trade a market? So it's really important to follow it accurately first. So if we take one of these candlesticks, and all the footprint is giving you a lot more information than what's high, low, open, close, because that's essentially what a bar or candlestick gives you. I'm going to separate the candlestick into sell market orders and buy market orders with the X in the middle. So if you just separate the footprint out, the X is always in the middle, right? This middle column. Along the right side are contracts that would have traded at a price when it's offered. In other words, it's representing aggressive buyers or buy market orders. In a later video, I'm going to show how you actually represent and become part of the footprint when you aggressively buy or sell it. And we'll do a live trade showing you how the footprint changes based on an order you put in. The dome changes when you put a passive resting order in, and the footprint trade changes when you actually aggressively do something. So when you think of the footprint, number one, think of it as a tool to read order flow. Number two, think of it as a way to track time and sales and aggressive buyers and sellers. So the right column here on your screen is buy market orders. To the left of the X are sell market orders. How many people aggressively came in with a sell market order and hit the bid when it was bid? All right, not really a complex concept, but one that has to be understood, so you're not looking at footprint charts and just seeing a bunch of numbers on the screen. That would be my first impression when I seen it, and I remember seeing it back in 2005 when it was newer to the industry in the prop firm I worked at. A guy by the name of Mike had a few guys surrounding his workstation, and he was showing us the footprint. He had subscribed to Market Delta. I didn't know what it was. It looked like a bunch of numbers on the screen. So you want to get into the footprint, understanding where they come from, and why is that value. Because I got news for you. Not all of these numbers are of value. So let's separate them out as we go through this rotation and thin spot video. This is something that I have to always go over if I'm talking about the footprint, and that's a back of your hand moment. If you're going to know certain things, this goes back to if it was my son that was learning to trade, I'd make sure that this was something he knew like the back of his hand. It can't even be debated. You have to know this It's only simple after you learn it, but it's not simple to those who never take the time to learn it. If you take another candlestick and representing what's it going to look like inside of it. Let's take a couple prices. Just for example's sake, evens and 1. Evens represented by the double zeros here, and 1. You notice how they're kind of on an angle, right? Because as I show a platform, the bid is often angled lower than the offer. The best bid, the best offer. So for example's sake, let's just say evens are the best bid and 1 is the best offer. Now, where the best bid meets the best offer is where the market's trading at this particular moment. If contracts are trading at the price of 1 when it's offered, it's going to show up on the right side of the footprint. If they trade on the even side, when evens are bid, it's going to show up on the left side. If the 1 is offered and the evens are bid, and I'm sitting here thinking, I got to buy this damn thing, I'm going to go and lift the offer where people are willing to sell it. Therefore, I'm an aggressive buyer. If indeed there was enough aggressive buyers to buy all the inventory up at 1, and they still wanted to buy, they turned the market from 1 offer to 1 bid. What would be the offer now? 2. 1 bid, 2 offer. For over 200 years, when we quote a market, bid is said first, then the offer. Don't ask me why, that's just the way it is. Bid, offer, bid, offer, bid, offer. What's the bid? What's the offer? Bid first, offer second. In this particular example, it would be 1 bid now, 2 offer. If I aggressively bought up all the 2s and still needed to buy some, I'd turn the market 2 bid, 3 offer, 3 bid, 4 offer, 4 bid, and so on. So you notice the diagonal relationship that you're going to see with imbalances and thin spots in a second. But then also the horizontal relationship of 1s across. Why? Well, because in any market, sometimes 1s are on the offer and sometimes they're on the bid. The footprint allows us a representation of how many contracts trade when indeed it's on the offer or on the bid. All right? So that's a horizontal relationship. There's both. And through this program of the deep dive, we're going to show you the value and how to tie both in together. Something I wanted to mention at the beginning of this that I'm going to mention now is that it's important to understand in rotations and thin spots, or in any kind of, this is my first in this series, but everything should be a building block. All right? There's always better ways to see the same thing. The concepts don't change, but to create better ways to visualize the same thing so you miss less are there. So everything I talk about builds into something that's going to help people read order flow. All right, so now let's take this footprint and throw it in the middle. Just for the example that I'm trying to give people, forget about all the numbers up here and all the numbers down in here. When evens were bid, 1,475 contracts traded on it, and when 1s were offered, 39.98. When the 1s went bid, 26.64 aggressively sold it. 36.11 contracts aggressively bought the 2s when they were offered, and so on. Now, something interesting happens when the market goes 3 bid at 4. 3 bid, 4 offer. 3 bid, 4 offer. This diagonal relationship is when the best bid of 3 meets the best offer of 4. You could see why is 26.83 green? Because there were a lot more people at this moment in time that aggressively bought the market, happens to be at 4, then aggressively sold the market, which was 3 bid. Makes sense? Only 56 traded on the bid, but 2,683 traded on the offer. Something unique happened in this particular moment in time that we want to make sure that's tracked so we have an easy reference when we go back for near-term and real-time support resistance. 3 bid at 4, something happened that created what's called an imbalance, and I often talk about it as a thin spot because the volume is thinner, as you could see in that area, than it is above and below it. Let's throw a platform or a dome. In this day and age, most platforms, this happens to be the Market Delta Cloud, but most platforms and domes or price ladders, as they're called, are the same. There's similar functionality across all of them, meaning the price is generally in the middle. The offers are on the right in red from top to bottom, or from bottom to top, and then from top to bottom in blue are the best bids. The contracts are represented in blue here. That's not people. That's the number of contracts that are willing to buy from the price that it's next to. These are contracts willing to sell at the price they're next to, all the way up and down the price ladder. If you exhaust all 520 of these 57 evens, it'll probably go up. That's the market going from 57 even offer to 57 even bid. Same thing on the downside. If you exhaust all 59 of these buys and there's none left, the market's going to go down, and 56.75 is going to go from bid, which it is now, to offer. And the footprint's going to track it accordingly. There are some importance with the numbers on the dome, but remember this. Here's the difference. The numbers in blue and in red represent how many people might want to buy it or sell it. Not necessarily the people who are buying or selling aggressively. The footprint represents people who actually put their money where their mouth is and actually trade, and there was a transaction that took place. These numbers could get pulled. Someone might want to buy it, pulls it, changes his mind. So while there is some value in the numbers that are in the dome and in the price ladder, they're not, in my opinion, as important as the numbers in the footprint. There is some value, but that's for another day and another lesson. Just understand, in the footprint, aggressive buyers and sellers or market orders. In the dome, passive buyers and sellers or limit orders are represented in the dome. And dome, for those that don't know, stands for depth of market. So then when you see the footprint and all of these numbers next to the price, it's representing the activity that took place at those prices when they were bid and when they were offered. Now, let's tie in rotation with some of this. If 57s are offered, which they are on the price ladder right here, okay, and they're traded a lot more in this sequence than the 56.75s are bid, the market should go up, and it does, as represented in this, not candle anymore, but footprint. And then the market might come down, go up, come down, go up, and so on. Building a story means going back to what kind of visual representation I want you to have when you see this. Before you look at all the numbers or all the reds and all the greens, I want people to understand that this market went up, came off, re-rallied, came back off and retraced, and then chopped around in here. That's the way your mind should have read this chart when I laid it out. And hopefully from now on, that's the way your eyes are fixated on every chart, no matter what the time frame is, no matter what the chart type is, candle, bar, footprint, Renko, point and figure, doesn't matter. Rotation is what's key. Your visualization and the way that your eyes that look at this no longer just becomes the numbers on the screen, but now the rotation that's important. Or else they're just, again, a bunch of numbers on the screen. We don't want that. So when you look at this, you could say to yourself, the market got thin in here. We know that by less volume that traded inside that yellow square. And before we know any of this, because that's the business we're in, trying to accurately assume with some semblance of predictive skills what might happen next, we could start to build the story out that there might be indeed near-term support as measured by that white dashed line that I just drew in, where the market could indeed come back down and show a bottom and re-rally. It begins to strip the word random out of the equation. Why is that? The reason you strip that randomness out is because something happened here you can now focus on that didn't happen or you wouldn't have been able to see happen had you not had a footprint and this type of imbalance to focus your attention. So 57 even, something happened that didn't happen up and down the ladder. There was a little speed that came in. where not only were there more aggressive buyers than sellers, but there was a lot more to create this thin spot and pop to create real time, in this case, support. When you're learning and you're educating yourself, you always got to think about what's going to separate me from the rest of the world as far as information and what to do with it. How am I going to miss less good stuff? Well, if you don't know what you're missing, how are you going to eliminate it? What you're normally missing, and I think anybody who's watching this program, this video, who's traded for a while, what most people do is they prepare with homework before the session starts with levels of support resistance. Some are good at it, some are okay, but most people will do it before the session starts. How about after the session starts, as the session's trading in real time? How good are you at adjusting and recognizing where near-term support resistance could be because it just happened after the game started? American football is a great example where they prepare for a team, but the best teams are the ones that have leaders like quarterbacks that could adjust to real-time information when they get up under center and are about to snap the football, because the defense is showing them something that they might not been able to prepare for or see when they were practicing to play that team. So we could practice and prepare, and that's important. But you have to put yourself in a position to read the real time as best as possible. And I could almost assure you that most people who try to do this will never put themselves in a position to read the real time. It's too hard for them. So that's an advantage or an edge that you're going to be able to create over them. So let's go back to this 57 even price where this unique imbalance happened. How does an imbalance happen? Obviously, more buyers than sellers that were aggressive. I'm going to show when I go to a market delta chart how you could change the filters of what would make this go green and maybe set the filter differently to have more greens or more reds, and we'll get into that. But it shows you that there was a big rally in here. Let's redraw it. There was a big rally in here, and something unique happened inside this yellow square. Could it be near-term support resistance? Absolutely. Is it highly probable? Absolutely. How do you play it? Well, if you're bullish anyways, you could think of not only where you want to get long, but where are you wrong, and that's below it. What I want people to understand is that your first target after you get into a trade is not where you're going to get out for a profit, but where you're going to get out for your loser. Know where you're going to get out before you get in for your loser. Manage your risk before you even take it. Well, when you have good levels of support resistance, you know below those levels, not necessarily one or two ticks below them, but below those levels is where you could say, this is a better place to put your stop to get out for a loser. There's all kinds of videos I have done and I've created in our comprehensive courses about why you don't want to be where other popular stops are. Those are like magnets where you want to have invisible stops, meaning you're putting your stop where others aren't. The better chance you're not going to get elected, therefore better chance you're on the right side of the market, and so on. But for this deep dive course, I want people to recognize real-time support resistance. And like I said about building blocks throughout this course, there are going to be later sessions in this program where I have made better visuals called edge zones that you're going to see later on that are really going to be helpful. But you have to understand where these come from and why in order to then go ahead and be able to play them. So understand the rotations first, back and forth. Understand there was a thin spot, something unique happening in this 57 even area, and how it would have drawn a line across to show where the bottom consolidation might have taken place. So far, so good. Now, going through this, before you came into it, in the videos before you watch this one, you go and you have to ask yourself, do I know more about this footprint than I did 2 or 3 videos ago? And I think everybody would say, yeah, they do. And that's what's important to us, trying to make sure these aren't just numbers on the screen. How to use them. Up bars, down bars, up bars, back and forth we go. Better be the visual you now have on a footprint or any chart type you look at. Going on to just a simple chart. These are bars now. I have on the whiteboard behind me in the office I'm doing this recording from, I want to be an expert in simplicity. It says expertise in simplicity. Everybody in most every industry, including trading, try to overcomplicate and overthink every situation. I want you to be able to strip it down with the right information to be an expert in what's simple. And trust me, that's going to give you an advantage because most people overthink everything that they do. So in a simple image like this, here's a high-low open-close bar. I'm going to pull one out. This is what it looks like. Here is a footprint next to it. A lot more information than high-low open-close, which is the only thing that you see pretty much in a bar. There could have been a lot of things that happened inside this bar that you don't see that the footprint starts to strip out. Now, I could pretty much tell you that this was a market that moved lower in price. How do I know that? Because there's a lot more reds in it than greens. So there was a lot more selling pressure. I'm going to think that any one of these areas is going to be a place where the market's probably in this area going to stop and rotate. It's going to be the high of consolidation, maybe the high of a pullback, and the market's going to stay weaker because of all this selling pressure and kind of where it came in. But I want people to understand why and where thin spots are, such as just the view of how a market gets thin in certain areas where you see it highlighted in red. Also know when you're looking at thin spots is to understand that the market picks up tempo, all right, and the relationship is diagonal. That way when you're looking at red imbalances. This way when you're looking at red imbalances. The difference between whatever price this was versus whatever price that was, like on the previous slides. The other thing I want to make mention when trading or looking for thin spots is it's showing you that the market picked up speed. How do we know that? You're going to see it when you see live red imbalances come, but when you're looking back and trying to figure out how the market reacted in a certain area, you know it went fast through this area because it highlighted in red, which means people came in and left little volume in its trail, which means people came in quickly to sell it. And the market might have went down fast inside those areas or around those areas. Why is that important? Well, just think, if you're sitting in a room and someone runs really fast in front of you, it's probably hard to determine what they were wearing, what they look like, versus if they walked slowly in front of you and left the room. You will be able to describe them much better. So you would have missed something if they ran through the room real fast, correct? Well, what do people miss when the market moves down fast? What do they miss doing, buying or selling? They don't miss buying it because it's moving lower. They're able to buy it at better prices. So they're certainly not missing buying a market that's going down. They're missing the sell. They're missing the sell. Why is that important? Because anytime you miss something, if you get another chance to get what you missed, you're anxious to try to do it. So if it's true, people missed, for instance, in this area, trying to sell it. The market ran down, and now it's starting to walk back up. I can guarantee you, if indeed people in this yellow box miss selling it, they're all sitting up in here helpless, begging, praying to sell it where they wish they would have got it before it broke. That's the definition of resistance. And if you could see this in real time, think of the edge and advantage you have over those who don't. Think of the edge and advantage of that, how much more you know than you did before you were exposed to the footprint and this deep dive of it. You get a lot of people that are trying to sell it with resting offers up here is what makes the market unable to go through it, and often will then pull back and return lower. One phrase I didn't put in here that I always try to say because it's resonated with everyone that's heard it: after you buy it, you're a seller. After you buy it, you're a seller. What does that mean? After you buy it to get long, you now have to sell it to cover that position. I don't care if you're going to sell it in 5 minutes, 5 seconds, 50 years. You're going to have to, at some point, get out of that position. And if you were caught long when the market quickly went against you and went lower, you're going to be one of these in the yellow box desperately trying to sell it if you get another chance. And you're going to be the reason why the market has resistance or comes into resistance. All starting from the recognition of trying to find out where the market moves fast and in which direction it moved fast. The red imbalances help do that. I'm going to show you some cleaner examples on a chart to kind of cement the point home. But just remember, real-time support resistance is like going up to the line of scrimmage, if you know anything about American football, and being able to read the defense and make an audible or change what you're looking to do or stick to what you're looking to do, which means confirm it. But if you walked up to the line of scrimmage and you don't know what to look for, what kind of chance do you have of being and staying successful? These quarterbacks in football, and I'm not degrading them at all, but they're not rocket scientists. They're just good at knowing what they're supposed to see, and they're good at reacting. They have a progression. Here's what I see. I know the play I'm calling. Should I stay with it or no? You know the play that you're trying to call, the setup you're trying to look for. Is it confirmed? Is it not? Should I qualify it? What am I able to see now as opposed to everybody else, mostly who I'm trading against, who's just looking at the past in order to predict the future, and yet the present is where the value is. Most people just use the past to predict the future, and they ignore the present. Let me clean up some of these illustrations here and go to a live chart. It's not live, but a chart. Blow it up. I left it pretty blank. These are delta profiles on the right, which we are including in some of the videos in this deep dive. So let's not pay attention to those at this moment. Let's just look at the footprint, right? Let's just look at some examples of imbalances. Again, the relationship is always going to be between the best bid and the best offer. So when we look at these, let's look at some of these red imbalances, the relationship between this guy and that guy. It went red because a lot more traded on the bid, aggressive sellers, than traded on the offer, aggressive buyers. Went red. Same relationship between these two guys and these two guys. First things first, I take this for granted. That's why I try to hit home and underscore it around every video I do. First things first is how your eye should have got fixated on this chart. Rotation. So it's not just a bunch of numbers organized in a rectangle. Really important. All right. So let's go in and just to understand what a thin spot would be, it's physically thin, right? See how it gets a little fatter in here, thins out, comes back in. Same thing. Gets thinner, comes back out. It's a thin spot. It moved fast. How do we know it moved fast? Well, number one, there was a red imbalance. And then secondly, there wasn't a lot of volume left behind. If a market moves fast, it's not going to leave a ton of volume behind it. Makes sense. So if it moved fast, not a lot of volume, it becomes thin. It's pretty decent near-term resistance. Market came up here, walked back down to this thin spot, which were aggressive, quick buyers that came in. No coincidence that that's where support was. So in this example, you're better off, if you don't know what's going to happen in here, you're better off certainly knowing how this candlestick turned into a footprint and showed where the tempo picked up and how it became real-time resistance. Now it's less random than it would have been if you knew nothing about the footprint, nothing about me and this education. You know a lot more, and there's less randomness than there was before you started this video. After you buy it, you're a seller. And if you wanted to sell it here, and you might not wanted to sell it there when the market was here, but when you seen the damn thing come all the way down in here, I guarantee you wish you would have sold it up there. You probably wish you would have sold it up here, but you at least wish you would have sold it when it really started to break out. So now you're getting another chance to sell it, and you're desperately trying just to get out of that long position and trying to sell it. That's the definition of resistance. If you're going to trade support resistance for however you come up with your levels, you better know why they would work. The true dynamic as to why resistance would be true resistance and support would be true support. If you don't understand that dynamic, you're going to have a hell of a time trading it, qualifying it, being consistent at it. What I want people to do in kind of a theme through these videos that I do with now educational courses I do is keep it simple, be an expert in simplicity, but just do what you say. You would think that that's easy, and it's not. When I'm trading poorly, it's because I'm not doing what I said I wanted to do. You would think again, well, that would be easy. It's never that easy. You got to review and reflect on, am I doing what I said I was going to do? That whole stick to your plan type of thing. But you have to have a plan that has the concepts and the dynamics that truly make price move. The footprint begins to tell that story. With number one, rotations, do not take for granted how rotations are really important to follow in reading a chart, and then where the hell the tempo picks up, both to the downside and to the upside. I'll get into adjusting these imbalances in later videos. We'll get into filtering some of these footprints as to just big buying and selling that comes in. So stay tuned for that, because you don't want too many or too few to come in. Like any filter, a rule of thumb, and I'll tell you this now, any good filter, if there's too many instances, it's not good. It's not a good filter. If there's too few, it's too good of a filter. So you want a nice sprinkling of buy and sell imbalances. And when we talk about the footprint filter, you want kind of a sweet spot on how many you see. Too many, it's not filtering really well. If it's too few of them, you know, your filter's too good. If there's too many of them, it's not good enough. And you just go through that. But these imbalances are set. In fact, let me show you guys now. If I do it again, it'll just be good confirmation or review. If we go into the footprint and right click, okay, you're going to have this window come up. And modify FP means modify footprint. Right now, the reds and greens have a imbalance percentage of 1,000, which simply means the relationship between the best offer, best bid, if the contract's traded is over 1,000 or technically 10 to 1, you'll go red or green. Then, and this is important, a min difference of 200, meaning the total of them has to be over 200. So we don't necessarily get examples of 10 contracts by one, because a lot of times there was nothing going on. Maybe that's not as important. So you could adjust this min difference, min diff as it's called on Market Delta desktop, to whatever you get to find a healthy amount of red and green imbalances. Going back, though, if you don't know why the imbalances would go red or green, then you got to go back and understand in these deep dive videos what would make it go red, what would make it go green. That has to be, again, a back of your hand type of moment. So let's just change this, for example, to something low, like 100, and apply it. See how many reds and greens pop up? Too much information, or just not enough qualification. Almost every level's an imbalance because you're really not having a decent percentage. So you could walk this up and down to 500 or 600, apply it, and start to pull back. Now I'm showing you examples from the S&P 500, the E-minis. We'll show examples of crude oil and gold and other markets because the footprint is applicable across all markets. I'm just using the ES for an example. So the platform I showed, the charts I showed, the images I showed, essentially are from the ES, but there's going to be different percentage imbalances, imbalance percentages you're going to use for different markets because liquidity and the volume that trades in different markets are different. The NASDAQ is going to have different volume imbalances and min diffs than the ES. Just giving you an example of how to change this so you get more or less based on what you're trying to go after. First thing to know unequivocally when you went through this video is rotation, how your eyes should now accurately fixate on a market, and then different spots and areas that the tempo picks up, which leave thin spots behind it. You guys that have taken this class, and I try to break off and not just giving just straight education, but break off into really complimenting people who invest in education. Nothing is free. Success doesn't come free, but it's very difficult in this environment to find good education. A lot of times you don't get what you pay for. And while that, isn't great, I really don't have sympathy for people that don't get what they pay for in other areas because I've paid a lot of money in the education, just in the profit splits I've had. First 3 years of my career, I had to give 50% of my profits up, 25% the next 4 years in my prop firm career. I'm not bitter about that, but it's important to understand that everybody has to invest in their education. And if you didn't invest in bad education, how are you going to be able to compare it to what's good? And that's the feedback and reaction I get from people that have invested in what I have for them, and that is, this is different and great, not only versus what they have, but just the understanding and the dynamic of how price moves. Going back to my first slide, why markets do what they do. Everybody else wants to teach you how. I'm here to teach you the why. Now, how will come a lot easier. We'll see you guys at the next video.